One of the biggest things I see on the internet when it comes to personal finance advice is the suggestion to put your money in a high yield savings account, especially versus dividend stocks or investing in the market because it has no risk. Now, while I do think high yield savings accounts have some use, I'm going to make the case as to why I believe dividend stocks or just investing in the market in general is a better long-term strategy. In this video, I'm going to explain what a high yield savings account is, good times to use a high yield savings account and where it makes sense, and then I'm going to explain why I think investing or dividend stocks is a lot better option to grow your wealth. So let's jump right into it. So a high yield savings account is exactly what it says. It's a savings account that pays a percent of interest for the money that you put in, and it's a very safe way to store your cash without having to worry about any downside risk. It also lets your money work for you by making you that percentage interest, which is a lot better than a traditional savings account that gives you practically nothing. Right now, I'd say the main range for most high yield savings accounts is between 4 and 5%. So they're really popular right now because of economic uncertainty. And also the reason they're so high is because interest rates are high right now because the Fed has pumped up rates quite a bit to slow down the rate of inflation. Now, back in 2020, when the Fed cut rates during the pandemic, I'm pretty sure they cut rates to about 0 to 0.25%. It would have been impossible to find a high yield savings account that pays 4 to 5% like what we're seeing today. Now, in my opinion, and I emphasize opinion on this, I think a high yield savings account is great for a few different scenarios, but growing your wealth long term is not one of them. So let me explain the scenarios first as to where I see a high yield savings account making the most sense. Scenario one is that if you need to save up for an emergency fund, whether that's 3 months, 6 months, or 12 months of living expenses, that makes perfect sense to me. Throw that in a high yield savings account. It's better than getting nothing for your money. You're going to be storing cash. You don't have any downside. You get to, save up your money, get that 4 or 5%, and let that, interest accumulate on that savings. So I get that right there. Reason number one is the emergency fund. Makes perfect sense to me. And reason number two is that if you're saving up to buy a home, this also makes sense to me because if you're putting a ton of money in at one time, you're saving up to get that 10% or 20% down payment, then you can slowly grow your savings and also get a little bit of interest on it. So it makes perfect sense for an emergency fund. Or if you're saving up for a big purchase. I just used the home as an example though. Now this is the part of the video where I might give you guys some hot takes, so a lot of you may not agree with this, but these are facts, so take it or leave it, plain and simple. I do not believe a high yield savings account is a good tool to grow wealth long term, and I think once you have that emergency fund, and whether you already have a house or you don't plan on making a big purchase that you need to save up for, then I believe your leftover money should be invested in the stock market, whether it's you just buying the S&P 500, some type of diversified ETF, or buying dividend stocks that are good companies with good financials. Reason number one is that let's say you have a high yield savings account and you're getting that 5% rate, which is really nice. 5% a year doubles once every 14.4 years. You use the rule of 72 for that. Look it up if you've never heard of it. So you're not growing your wealth, you're simply storing it, which like I said, this makes perfect sense for an emergency fund or a house, but this is not a good long-term tool for growing money, which leads me to reason number two. Reason number two is that rates will not stay high for that long. The high yield savings account rate is directly correlated with interest rates. So if the Fed tends to lower rates again, I'm not saying cut them to zero, but if at any time the Fed starts lowering rates, then that 4 to 5% is going to shrink down to 3 or 4%, 2 to 3%, or maybe even 1 to 2%, or potentially lower. So it won't stay that way forever is the point I'm making. Reason number three is that the stock market has on average returned about 10% a year over the past 30 years. So if you think a high yield savings account is beating the S&P 500 long term, then you're probably going to be wrong. And reason number four is that some people will say, put your money into a high yield savings account, and then when the market picks back up, then you could start investing again. Now, I personally think this is absolutely horrible advice because if you miss out on even the best 10 days of the stock market over a long period of time, you can be cutting your total return in half. So most well-seasoned investors know this phrase, and they've heard this phrase a lot. Time in the market beats timing the market, and I am one of those people who truly believes that. Reason number five, and this is specifically with dividends, I see this one online quite a bit, is why would you buy dividend stocks when a high yield savings account can give you 4 to 5% with no risk? Now, I do think this is a reasonable question, but 2 words answer it. Capital appreciation. Most dividend investors, especially dividend growth investors such as myself, invest in stocks because we want the stock price to go up over a long period of time. We're not just buying the stock in hopes that the stock price sits flat while we get paid dividends. Let me show you a quick example. If you put $1,000 into a high yield savings account and you get 4% return, then you'll have $40 after year one. So that would go from $1,000 to $1,040. But if you invest $1,000 into stock A and receive a 2% dividend, which is lower than that savings account rate, but the stock goes up 8% a year, then after 1 year, you'd have $1,100. And that's not even factoring in a company that grows their dividend or you reinvesting that dividend to buy more shares, which creates an amazing compounding effect. Now, if you're too worried about what the market might do, so you put all your money into a high yield savings account, then I would honestly suggest just buying a basic finance book to inform yourself further. And truly, I don't mean to say this in a condescending way, but if you educate yourself and learn about finance, you know that this is not a good long-term strategy, especially if the Fed decides to cut rates. I believe just investing, even if you're just buying the S&P 500, it's probably going to be a lot better move long term. So that is my take on a high yield savings account versus investing, especially against dividend stocks. Again, I think it's a great tool for putting money on the sidelines for an emergency fund or to save up to buy a home, but not a good tool for long-term wealth building. And if you have a 20, 30, 40-year timeline before you need to retire, I don't see the point in avoiding this much risk. Your risk tolerance can be higher than this, but like I said, I think it's good for storing wealth. What do you think of the high yield savings account? Comment below. I hope you guys enjoyed this video. If you did, drop a like down below. Hit that subscribe button for more content like this, and I'll see you guys in the next one. Peace.